depreciation. Quite a straightforward part of the course, so we'll go through this quite quickly. So depreciation appears on, this is the profit and loss. Sorry, this isn't the profit and loss, this is the balance sheet, but it also appears on the profit and loss as well. So I'll just take you through the balance sheet. So it doesn't appear on the one that you maybe saw in your Unit 3 exam, but on actual balance sheets and profit and loss accounts it would. So if you looked at a company's, and you should have a look at Google Finance. They have a lot of PLCs or publicly traded companies listed on there, and you will find depreciation on there. But I've got an example of a truck here, and the reason is because on your balance sheet it's meant to show what the business owns and what the business owes. So that's in terms of assets and liabilities. But if you said that, oh, you have a truck and it's worth £20,000, and the auditor comes to check that that truck is worth £20,000, they're going to be very disappointed if they come into the garage and see that that's what the truck you're describing. They say, well, that's not worth £20,000. And you would say, well, you know, I bought it for £20,000. And the problem with that is that you know, the value of the truck is depreciated in value over the years, obviously, because you've not replaced the windscreen and you've let it rust. And depreciation means reduced in value. And so when you're presenting a balance sheet, you're putting a balance sheet together, you've got to present a true and fair and accurate view of the business so that potential investors or other stakeholders can make good decisions. So that's why we have depreciation appearing on the balance sheet, because we have to depreciate the value of assets over their useful life, so that you're not making the value of the assets of the business look like more than they are. And depreciation also gets taken into account. Most students understand it when it's on the balance sheet, but most students don't realise it's also on the profit and loss account. So if we're looking at a building project, and we're thinking, well, the cost of the building is going to be, you know, say £20 million, and the lifespan of the building will hopefully be 100 years, then it's probably not very fair to take the £20 million out in 1 year. So if we had £20 million here, then it would distort the profit figures, because then that year you'd maybe not make very much profit, obviously, but the year after it would suddenly go much more positive. So depreciation, when it's on a profit and loss, and it would come under expenses or overheads, is to spread out the value of an asset over its useful life, so that you're more accurately representing the cost to the business. So you're not representing when the money actually left the bank account and paid for the building of the new building, but you're more accurately representing, well, how was this revenue up here generated? And part of that will have been from having the use of the building. So even in 50 years, if you've got the use of the building, it's true and right and fair and accurate that you should report and spread the cost over the useful life, even though in reality you're not spreading the cost, you've already paid for it kind of 50 years ago, but it gives you a more accurate view of what the profit is that you're making. So depreciation is therefore a reduction in the value of a fixed asset over time, or the allocation of the cost of a fixed asset. So most students understand this one, most students don't, look at this one, but it's actually, just in case you're going to university, you're going to study accounting, or you're hoping to become an accountant, depreciation is just a little bit more than sometimes the AS textbooks explain. So you can read this through in your own time if you want to pause the slide, but let's get on to the mechanics of it. So we use the straight line method. There are different methods to calculate depreciation, but you only need to know the straight line method for your exam. So it's the cost of the fixed asset minus the residual value, which is the amount that you could sell the asset for, or the resale value or the scrap value that you'll get for it, divided by the life expectancy of the asset. And so if we've got an example here, a business buys a new company car costing, it shouldn't be each costing, but costing £18,000. They think the vehicle will have a life expectancy of 4 years and a final resale value of £3,000. How much depreciation will the business charge each year to both to kind of reduce the value of the asset listed on your balance sheet, but also as a cost in your profit and loss? So we've got 18,000 minus 3,000 divided by 4. We have to do all of that sum together before you divide it by 4, by the way, and you get 3,750. So that's how much depreciation you'd be charging to the balance sheet and the profit and loss each year. But say, sometimes the question might say something like, how much would the value be after 2 years? Well, we'd get the original value minus 3,750, and again minus 3,750, so 10,500. If it was 4 years, I'd just do 3,750 times 4 to make it a little bit easier. But as it was 2, I just minus 2 of the 2 lots of depreciation off. So a very simple section of the course, actually. But I'll just leave you a nice little cartoon that I found on the internet about depreciation and cars, and I thought that this was quite interesting.